Getting back in. A few thoughts. When I am actively taking profit and managing a trade, sometimes I will press my trades for more gains when the situation calls for it. This is more of an advanced risk-taking strategy, which I will be creating another detailed course for, but I at least wanted to touch on it here. Once we are in the market, only then will we have more evidence and confirmation of the trending situation we hope will develop. After we take our predetermined profits, but the trend continues to look strong, then we might want to re-add to our position to take advantage of the trend. At this point, we are only risking profit that we've already made, but that is no reason to be careless. We risk the initial loss for that profit, and we don't want a nice profitable day to become a break-even or even a loser because of taking poorly timed or placed risk. Now, because of that, I am much more patient with getting a good entry and much more impatient with crappy price action. So in other words, slow to add, quick to take off. We can always get back in once choppy waters have passed. So we have a couple of good options for this. So we can re-enter on a counter trend line break or a pullback to support and resistance. I have mentioned, or even value, right? I have mentioned that I really like it when we have an obvious market profile support or resistance level that coincides with the chart support and resistance. So for example, perhaps the market broke higher and is now pulling back to the previous day's value area high where a previous low was made. I would buy that in expectation of trend continuation. And if that level didn't hold, then I know that I need to exit and something is wrong, right? Or we can enter on a counter trend line break in the direction of the trend. And I like these because it shows me that selling or buying pressure opposing our trade has slowed and trend dominant buying or selling is taking back control. So let's look at an example, right? So re-entering a trade. So the first example, you can see where the value area high acted as support before it broke out to new highs, right? So we have the value area high here from the previous day, right? Or this is by the end of the day, this has already been developed, right? So we've got the value area high, we've got the VPOC, right? So price comes up, comes back down, tests the value area high, and then is rejected higher from there, right? So that's an example of trend continuation. And also you can see right here that you could draw a trend line, a counter trend line break. So you essentially have, you could have two triggers kind of supporting each other, right? Pull back to value area high, and then the trend line break higher, the reversal. So the second example makes it easy to see buying and selling pressure transition with obviously sellers in control overall, i.e. sell the uptrend line breaks to the downside, right? So in your typical trend line or downtrend, right, we've got the long-term trend line, right? We have the same thing happens that it does during the uptrends, right? So we have acceleration to the downside, right? Breaks away from the main trend line, right? And so price momentum reverses, right? So the buyers are in control. They take that back up to the trend line, to the main trend line. And then we, as price is triggered through a counter trend line break, then we enter back in the momentum of the trend, right? And part of the reason for this, I think should be pretty clear by now, and it's kind of obvious, is that during a downtrend, right, this trend line just shows us and gives us a visual representation of where buying pressure has exceeded the selling pressure and they're currently in control. It's just in the short term, right? So we can go through this and we can go, okay, well, we think that the market's going to continue to go down. So here's a little support or a little resistance level. Let's go ahead and sell that. Oh, that didn't work out. This looks like it accelerated pretty good. Let's sell that. Oh, that worked out for a second. And then, but it continues. Oh, look, it stopped me out again. Or we can just draw a trend line. And like I said, it's been one of the most consistent tools that I've used that just allows us to see specifically when the selling and buying pressure has reversed. And so that works for any time frame, any market, whatever. And so those are the things that I like to use. So again, and you can see that it works out quite well, right? We just waited for the whole entire, now you're not going to get the most ideal entry, right? But oftentimes, as momentum reverses and moves back in favor with the larger trend at hand, that's where most of the volume is going to be anyways. And so like even here, you had once, if you waited for this to happen, if you waited for the trend line to be broken back in direction of the trend, then you had almost no price, you had almost no negative price excursion against your entry, right? Now, this doesn't happen all the time, but you're going to find this more often than not as compared to other times when you're just kind of guessing where you should re-enter the market, whether that's a pullback to a 20% fib level or 31% or 50% or whatever. Those are, at the end of the day, are all just guesses, right? Here, this is something very real and tangible, and we can at least measure that. So at least if it broke and it reversed from here higher, I would take that as a much stronger symbol of, okay, the downtrend may be ending at this point and continuation is happening to the upside. It would give me more data. It would give me more information that I can use to read the price action and take this uptrend against the main downtrend a bit more seriously, right? Versus just guessing and it just being kind of an arbitrary level. So again, we counter trend lined break to the downside. We get nice price movement. Same thing here. Once it goes down, even though it consolidates, the momentum to the upside, you can see it's not able to gain traction, right? So it's very real to have a trend line break here. You place your stop above this level here, and then you just wait to see what happens. And even depending on where you're at in the market, you may say, okay, well, if my risk, if my entry is here and my stop is here, then it could make sense to say, okay, well, if the price gets back up to this level, because oftentimes it could potentially retouch this level, it should just not break out beyond that, right? So your stop wouldn't be directly above this, it would be kind of in this area here. Because again, risk reward, if we're looking from here to here, and our profit targets are down here, our risk reward is skewed in a profitable situation, right? So if price comes back up to here, we may sell another piece with the with even more little risk, right? Depending on our strategy and depending on the total risk of the trade, for it to just move down again and ultimately extract a bigger profit because we had even less risk on that leg of the trade, if that makes sense. All right, and then so same thing. So price ultimately moves down. Again, we get a nice, as soon as this little piece of market structure is broken to the upside, that allows us to create this trend line here, and that bit of buying pressure slowly subsides, and then we get our break, and then it moves lower, and again, we're back in line with the trend.